This is Back Roads of Illinois, server to farmers and ranchers in central Illinois and the Midwest. We're glad you're here on the Markets Club podcast at the NFB convention in Kansas City. This is the Markets Club NFB convention edition. I talked with Mike Castle of StoneX Financial Services. Mike is in the fertilizer division of StoneX. We talked about the uncertainty within the fertilizer space in Canada and demand for P&K in the Middle East. And I visited with Arlan Surdmann from StoneX Financial Services as well about the grains markets and counting on the beans markets with these trade in China. What we see the commodities prices with Arlan. This is the Markets Club podcast at the NAF convention. We're in Kansas City, Missouri for the NAFB convention. I am here with Mike Castle of StoneX Financial Services in Kansas City for the fertilizer division. Hey Mike, how are you, and glad to join us on today for Back Roads of Illinois.
Doing great. Good to be with you in person.
Great to have you. Mike, let's discuss about the fertilizer prices for this fall. What is your thoughts with today's trade barriers with Canada as we are talking for right now?
Yeah, so we finally got some good news on that front earlier this week. I think it was actually technically tail end of last week, but went into effect this week. But we're taking tariffs off of fertilizer imports, which is a great step forward for overall supply. Some products aren't necessarily going to be that impacted by this. I'd say really phosphate is the biggest one for sure, just because this doesn't fix the issue that we still have trade barrier-wise, which is our countervailing duties on Russia and Morocco. But these additional tariffs that we've had, in 2025, basically added tariffs to our, main source of supply now, which is Saudi Arabia, also Jordan with some significant amount. But overall, because of that, they've been selling elsewhere, most notably to India. So Saudi Arabia sold a bunch of stuff for this fall to India that typically, should have been coming this direction because we were less competitive with those tariffs in place. But now, obviously, pulling them back, that's great news. Again, kind of keeps that stuff hopefully pointing this direction. Now, it doesn't necessarily have a huge impact on the front end. Nearby supply doesn't really get helped from this. What's in the system is already kind of in the system. We know imports have been very weak. We only have data through August now. That just came out yesterday. The government shutdown has really delayed things, still kind of getting info. But again, moving forward, this should be good. So does it do anything for fall prices? Probably not. Things still look very expensive. I do think the demand side's probably been softer in large part because of that. From an affordability perspective, it just looks terrible. We've hit all-time, worst for the ratio when we're talking about affordability on the phosphate side. But again, it does look to be improving. We've seen some Q1 prices trade significantly lower. NOLA DAP, I believe, just traded a Q1 barge at $6.43 a ton earlier today. That, is over a $50 a ton drop from just a couple weeks ago. So, it's $100-ish a ton inverse, maybe not quite that much, maybe $80, but still, it's a good sign. And, I think the pricing does reflect the kind of market condition of, does this help supply today? Not necessarily, but hopefully we can see an impact by spring.
Can you tell our audience about P&K in Canada for this week?
Yeah, so thankfully on the potash side, Imports are still technically exempt under the USMCA, so there's not tariffs on them for now. Obviously, we've seen some less than ideal relations between the U.S. and Canada from a leadership perspective, which kind of threatens that. Thankfully, again, that hasn't been, actually put into practice. We're still able to bring in Canadian potash tariff-free, which is very nice. Obviously they have plenty of supply. And one longer-term thing on the potash side, specifically that benefits us, as we look at the global market, you see the big destination markets in Asia, especially like Southeast Asia, where demand's kind of growing. They're kind of, from a geopolitical perspective, losing favor towards Canada. So a big importer like China, you're seeing them bring in a lot more from Belarus, from Russia, and now from Laos, where they're, actively investing to expand production. And that basically means, demand in that area, the Southeast Asian countries who now, neighbor Laos, who's becoming this big producer, they have access to much closer supply with a lot better logistical, freight advantage, essentially, which means, Canada kind of losing market share in those markets, which shifts more to us. So again, that's a benefit to us longer term. That's more Canadian, North American supply available to come down into the States. So let's hope that we keep things tariff-free and we don't get into too much of a spat to jeopardize that. But, for now, knock on wood, we're still exempt under USMCA and doing pretty good on that side.
How about in the Middle East, Mike?
So the biggest thing there right now is watching this current India tender, and we have seen, some one-off sales at higher levels, but in general, the basically entire global urea market's been waiting for this India tender that just got, not, finalized yet today, but we did see offer totals today at 4.7 million tons. It's close to about double what they're looking for at 2.5. We don't necessarily have all the details on that yet, unfortunately. Love to dive into that more when we get them in the next few days. But overall, the big question now for the Middle East producers is, how much longer are they going to have to be competing with China? So China right now still exporting. They increased their quota again by 600,000 tons a week or two ago. So they've been selling stuff, especially when we look at, again, this major destination like India. Instead of it basically having to all come from the Middle East or all come from Russia, North Africa, wherever else, China coming in really gives them a much bigger competitor, obviously with them, again, having a freight advantage, being closer to the demand. So really, I think that's what they're looking for. And, even going back to the tariff side of things, seeing the tariffs get removed on the urea side, for example, is great news for us when it comes to that as well, because we're able to go back to sourcing from the Middle East. Again, they now have to compete with China and India. That means we don't have to compete with India as directly because more Middle East stuff can come this direction. Again, that's great news. What we did see in the hard data yesterday for August, again, that's not going to reflect the new tariff situation, but it was almost exclusively from Russia. We brought in, I think, like 90-ish% of our total supply of urea in August was from Russia, and that trend kind of is what we would expect to continue until now, moving forward that we have the tariffs removed. So I think most of our fall supply probably came from Russia because of that reason. But again, we get these tariffs removed. Hopefully that means pointing more Middle East tons this direction, which, again, hopefully can give us some help for the spring season.
Sure, Mike.
What confused me was the split of 35 as you're coming up.
How is the level of concerns about the fertilizer prices for next year after this growing season?
I would say, if you asked that question a month ago before this rally in the grain prices, farmer sentiment certainly would have been a lot more negative. Hopefully, obviously we've moved prices up to some extent here. Still certainly lower than we'd like to see from a farm perspective. Not great from an affordability perspective still when you're looking at the relationship between those grain and fertilizer prices. But, overall, they have improved to some extent, unless you're looking at something like, say, fall anhydrous right now, just kind of continue.
How is the level? I know that inputs costs are skyrocketing and demand is low with our neighbor to the north. But as farmers are finding some borrowing of financial aid for the fertilizer space, I know that we're not seeing the checks to our mailbox.
Yeah, and that's the big question. And hopefully, I think yesterday they said there was going to be an announcement soon. I don't know what soon means, I guess. So I don't know if that means this week, next week, and the next month. Who knows? But, I do think it's important when we're talking about that, especially from a fertilizer perspective and looking at next year's crop and specifically financing next year's crop. Even though prices have rallied significantly here in the last month, you got to keep in mind a lot of stuff got sold across the scale at much lower prices than where we're at right now. So, when you're talking about, the farmers, maybe we don't need these checks because, again, prices have rallied. When you're talking about, financing input decisions, whether it's for a fall application or you're buying something over the winter for the spring, that still plays a role. So, again, hopefully we get some details on that. And I do think, seeing those checks in farmers' hands will be certainly supportive for inputs, especially fertilizer, obviously being the biggest input typically.
How is your thoughts with inputs into next year?
I think a lot of it, again, kind of depends on, what we end up doing acreage-wise here. With, what we touch on here with the farmer checks potentially leading to bigger demand here on the front end, I do think there's also been a reasonable amount of maybe not necessarily demand destruction, but deferral into next spring. So, depending on what didn't go down this fall, we could potentially set up this situation where everybody's waiting until the spring and then everybody shows up at once and all of a sudden what looked like a good idea or a good price or, readily available supply turns out to not be the case. So I guess this is another time where I would say have the conversation with your supplier. Don't wait until the last minute, because if everyone does that, you're going to run into a situation where, oh boy, things are tight because we all had the same idea and showed up at once. And it's not like, your supplier can just get long at these values and sit on it forever and hope that, demand shows up. So they're subject to the same conditions in the market, right? We're all subject to what's happening globally because it's all connected, especially with us playing a bigger role in the export market. So again, I think it's just a good time to remind everybody to pay attention to the space. And, even though we're wrapping up harvest, we're wrapping up fall field work, moving into winter, it's still important to be thinking now about your plan for next season.
What is your final thoughts about the current demand for next year's balance sheet for the fertilizer?
So I think the biggest question from USDA's balance sheet. So the thing we saw them change when they updated the November WASDE, they upped exports by 100 million bushels. So we are by far a record, over 3 billion for the first time in history. And we're comfortably ahead of the pace needed to hit that, whether you're looking at it from inspections. I know sales are delayed, but even the delayed ones we got, like today's, was still massive, like 89 million bushels for the first week of October. So I think when we get caught up with that data, we'll see sales paces were still strong as well. So I really have no qualms about that export figure. If anything, I do think we could end up higher. But the biggest red flag on that corn balance sheet is the feed demand number at 6.1 billion. It is just flatly way too big, unless you magically saw the border reopen to feeder cattle shipments from Mexico. There's just no way we're going to feed that amount, right? I mean, we're looking at flat at best or less animal units to feed here. So it just doesn't make sense to see them have such an increase. I think it's like an 11% year-on-year increase from the last marketing year into this marketing year in terms of feed demand, again, with less animal units. And I know we're feeding to heavier carcass weights, but it's not going to increase by that amount. So, I do expect them at some point to walk yield back a bit more from the current 186.0, but at the same time, that's not necessarily going to come right off the balance sheet. What I'm expecting to happen is USDA will probably use that time to walk back yield and also cut feed demand with it, kind of move these things one for one. And truthfully, I'm kind of surprised they didn't choose to do that when they increased exports. Again, they increased them by 100 million, but left feed feed demand alone. And a big part of why we're exporting that number anyways is the fact that these cattle are getting fed in Mexico instead of here. So it's the same bushels. You can't be double counting them, but I think they're just trying to kind of solve for, a specific ending stocks number somewhere, around 2.1 billion, and that's what they did. So I do think we could see some more changes between now and January when they put out their final report. But again, I wouldn't put too much hope in, cutting yield, translating to some massive reduction in ending stocks, because I do think there are other, kind of holes to be poked in that balance sheet.
Thanks, Mike. I enjoyed our conversation in Kansas City from NAF convention on back roads of Illinois.
Well, thanks again for having me.
This is Mike Castle from StoneX Financial Services on back roads of Illinois in Kansas City from NAF convention. What is the fundamentals, trends, and demand report from the beans markets with these prices for right now? We're having a conversation about it with Arlan Surdmann from StoneX Financial Services Industry at the NAFB convention. Hey Arlan, how are you, and glad to join us for again.
It's really good to be back with you again. And you asked some good questions there about the soybean fundamentals. There's primarily two factors in our soybean demand side of the equation. We pretty much know it's a big crop, but what about the demand side? Will we consume everything that we've produced this year? And the two factors are exports and domestic crush for our biofuel program. And the biofuel program still has a lot of question marks by it, but there's a lot of confidence that we're going to have a strong program once EPA releases the final guidelines, probably somewhere around the first of the year. Hopefully it'll be sooner, but it could be later as well. But as we look at the crush reports that we've had this year, we've had 2 months worth of crush data, and the overall crush totals were over 20 million bushels higher than the previous year in both cases, showing how we've increased our crush capacity in this country. That's very good news because our exports still have a lot of question marks. Our exports are going to be dependent on China. Do they follow through with their agreement to buy 12 million metric tons this winter? Do they follow that up with 25 million metric tons, as the White House said they committed to for the next 3 calendar years? Those are questions we don't know. They don't have a real good track record for following through, but they are buying, and the market is right now wanting to believe them. So with strong crush and with better optimism, shall I say, about exports, there is some optimism now with fund buying coming into the soybean market. It is volatile from day to day as the various rumors hit, but the overall trend has been higher, and that has given a sigh of relief in farm country. They have the opportunity to sell some soybeans at a more respectable price. Maybe not what they'd like to yet, but more respectable than what we were looking at a month or two ago.
What is the technical aspects on soybean futures for this week as we speak for this morning?
Well, I think one of the interesting things is I look back at the history of soybean futures, looking specifically at the front month, is historically we spend very little time in the $11 area. If we go in above $11, we either collapse back into the $10 range or we shoot right through $11 to the $12 range. There's no guarantees about that being the case this time around. But that's a historical tendency of the market, and a lot of it's driven by the funds. They figure if there's enough money, if there's enough incentive to bring us into the $11 mark, then maybe that's enough to take us into the 12 or higher level. But as they get up there and they just don't find enough support for that, then they collapse back lower. So maybe that gives some optimism. The charts are certainly looking better now, and the funds are kind of pulling their money out of the livestock sector right now, with President Trump talking about lowering beef prices, and they found that the grain and oil seeds were maybe undervalued in some ways and at historical lows, and so they're pouring money into the grain and oil seeds.
Of course. Arlan, how are the fundamentals with the corn markets for right now? Could you tell our audience about the fundamentals with the grains markets?
As we look at corn, I'll do the bad news first. And the bad news is, of course, it's a big crop, and USDA said 186 bushel per acre in their November report. And they'll change that in January, and historically big crops get smaller. But there's a big supply this year. It's just how big is the question. So then we look at the demand side, and can we get rid of it? Again, as we look at the negative side of it, feed usage is too high. USDA is calling for a 600 million bushel increase in feed usage this year with fewer animals being fed. So that doesn't add up. I think their last year's number is too low, so that offsets that partially. But I do think that their feed number needs to come back down 200 to 300 million bushels at the minimum. And their ethanol demand number is too high as well, by up to 100 million bushels. So that's the bad news. The good news is that export demand is at a record clip and by a long distance. If we export sales data is very delayed. We only have data now through early October, but the seasonal pace, the marketing year-to-date corn export sales that we have reported to us exceed the seasonal pace needed at USDA's target, and that's a record high target, by 200 million bushels. The export inspection data, what's actually being shipped, that's pretty current, and that exceeds the seasonal pace needed to hit USDA's recently upwardly revised export target by 150 million bushels. So exports are very strong. That's helping to offset some of the problems with feed usage and with ethanol demand. And so then it comes back to when USDA lowers the yield, if they lower the yield in January and they lower feed usage, can exports be strong enough at that point to draw us below 2 billion bushels? And that's yet to be determined at this time.
You mentioned that we have borrowing money to the grains markets. How much should be able to get the fundamentals in the cattle markets for next couple weeks ahead?
Well, right now we're kind of going into blind because there's still a lot of data that we don't have from USDA. It's trying to catch up, and we talk about the export sales data. We're not going to be caught up until the end of the year, and we talk about the funds. We're not going to be caught up with the commitment of traders reports until deep into January. So we're estimating at this point. We don't know for certain. But the cattle market, we know that supplies are still tight. We have a cattle on feed report coming out this weekend. We anticipate it showing on feed numbers down another couple of percent. The question is what is President Trump going to do to increase the supply of beef? Is he going to, he already took off their 10% reciprocal tariffs on beef. Will he take off the remaining 40% on Brazil that still continues to be a problem moving Brazil beef into here or not? If he doesn't, then that helps keep beef supplies tight and helps support prices despite the fact that the funds have been leaving the cattle market. If he does, then that could help relieve some of that supply problems. And with our large carcasses and stuff and our imports, we could help meet that demand. So a lot of question marks remaining. So a lot of the money moving from the protein sector over to the grain and oil seeds on the hopes that China gives us a story there.
This is really interesting, Arlan. We know that it's tough with the farm economy. How is the cash grains markets for right now?
Falls apart, then it won't. And I think the key to that is going to be their position on rare earth minerals and magnets. Even though they agreed to allow those to flow, they're starting to renege on how they do that. And that's a national security issue. And so we stand the risk that President Trump could come back with his 100% tariff threat, and that might shut off Chinese purchases, on just a moment's notice. So that's the risk that we're facing going forward.
How is the seasonal markets, Arlan?
Well, from a seasonal standpoint, we're now past the harvest for the most part, and at a time when we tend to see things strengthen a little bit into the turn of the calendar year, the new tax year, so to speak. So that's a positive time. The seasonals are kind of turning up right now. But we have to keep in mind that fund positions are a big part of this, and they don't necessarily pay as much attention to the seasonals as what they used to.
How feel about the cattle markets with the feeder cattle for right now, Arlan?
Oh, for the feeder cattle, we've certainly seen quite a roller coaster to record highs and then a collapse lower. I think the real key there is, when does the Mexican border open up? The New World screwworm is still a threat, although we're making progress working with Mexico. Mexico's been very cooperative here of late. Mexico really wants to see the border open up. President Trump really wants to see the border open up. There's a lot of people in the cattle industry that want to see the border open, and a lot of other people who don't want to see it open. So it's a contentious issue at this point. But that's what the futures of the feeder cattle market is going to hinge on, is whether we open that border up anytime soon or not. If we do, then that dramatically increases the flow of cattle back into the United States. At one point, we were averaging like 30,000 head a week for feeding in our feedlots. That would also reduce corn exports, as we would feed more of the corn here in the United States. If the border stays closed, then we feed those cattle down there. Corn exports stay strong, but feed usage drops.
How is the cash cattle side in the north?
The cash cattle market's been a little bit weaker thus far this week, and part of that is we have a shortened slaughter schedule next week with the Thanksgiving holiday. And part of it is with the break in the futures. We had feeders who had hedged their supplies, who took advantage of the basis opportunities on the break in the board and let go of their cattle at weaker cash levels. So it's been a little bit softer. The expectation was that maybe we would see steady cash this week, but that hasn't been the case so far. It's been on the soft side.
Do you have any final thoughts or recap of our conversation about the grains markets with these prices?
It's all about your margins and letting go of trying to get the highest price or what we'd like to have. Obviously, we'd all like to have $8 corn and $15 soybeans, but focus more on the margins and the business and whether the price is giving us an opportunity to make sure we're in business a year from now. This is a rough part of the ag cycle. We just need to make sure we survive this part of the ag cycle until we get more sustained, better days ahead, which we do believe is coming.
Of course, about management and management. Of course. Thanks, Arlan. Enjoy your day at the NAFB convention today. Arlan Surdmann from StoneX Financial Services in Kansas City at the NAFB convention.
Thank you, Cesar. It's great to be with you again.